Hey, what's up guys? Welcome to Accounting with Karim, and in this video we're looking at the 4 different types of adjusting entries. Before we get into the video guys, as a reminder, integrity and honesty is the key to credibility. So let's dive into the video. Let's look at the 4 different types of adjusting entries. We have 2 categories. We have prepayments. Under prepayments we have prepaid expense and unearned revenue. Under accruals, we have accrued expense and accrued revenue. So let's see the definition for each and an example for each. So prepaid expense, expenses paid in cash and recorded as assets before they are used. Unearned revenue, cash received and recorded as a liability before revenue is earned. Accrued expenses incurred but not yet paid for in cash or recorded. Accrued revenue, revenues earned but not yet received in cash or recorded. So those are the definitions for each of the adjusting entries that we have. And let's look at different examples for each so we can have a better understanding of all these 4 types of adjusting entries. So prepaid expense, say for example, it's the start of the fiscal year and we purchase an insurance policy for the whole year, so for 12 months. It's January 1st. We haven't used any of the service, that's number one. And for the first month, we cannot allocate the full cost of the insurance for the first month. We have to allocate the insurance evenly throughout the 12 months. So on January 1st, that is a prepaid asset because we haven't used any of the services yet. So that is a prepaid asset to us. On January 31st, when we're doing the adjusting entries, we have to allocate a portion for the month of January and the rest will still be on the balance sheet as prepaid assets. That's a good example for a prepaid expense. Unearned revenue. So a customer comes up to us and said, hey, I want you guys to provide a service to us in a couple months. Say, no, it's January now, in March, but we would like to pay you in advance. The money that the customer gives to us is not ours, it's a liability. So we cannot say we earned that money as yet until we perform our side of the obligation to the customer, which is to provide a service. So that is a liability until we complete our part of the transaction, right? So yes, that will be on your balance sheet as a deferred revenue. Accruals, so accrued expenses. A good example for accrued expenses would be payrolls. You know, payroll is always 2 weeks behind. So for example, we're getting paid on January 31st. The pay period that we're getting paid for on January 31st is actually January 1st to January 15th. And so from January 16th to January 31st, that pay period will be paid on February 15th. So employees provided their services to the company in January, so we have to record that expense in January. We cannot wait until February 15th for us to say, hey, to make that transaction, to record that transaction. So that is a good example for accrued expenses. So we have to accrue that expense on January 31st and not on February 15th when the payment is made. Then accrued revenue. We have accrued revenue. We say we've earned the revenue. We know the customer will ultimately pay us that money and we already provided services, but we haven't yet received cash. So we have to make an accrual for revenue at the end of the accounting period to make sure that the revenue is in line with the correct accounting period and also in line with the expenses that were incurred to generate that revenue, right? Those are the 4 different types of adjusting entries that we have to make. The reason we need to make these adjusting entries, we're doing accounting on an accrual basis. So there is always will be a timing difference, all right, between the service and the cash payment. All right, so that's it for this video. Until next time, I'll see you guys. Cheers.